I mean, we'll still give it 3 more minutes, but Alfonso is here. Do you see? I'm starting to feel a little better. You guys are gonna like the little text that I did. It's nothing, right? But so I guess all right. Let me just shoot a last message. For the people on Discord. We might not even do this whole hour, you know, unless people want to do chart request. We got pretty sure. Yeah, I don't recognize. I think I know Jet is here. I think Futaro, Okami, and I think the other one's below. Hold to Diamond Can. Hold to Diamond Can. I mean, I didn't even on my other account. I didn't even Diamond Can, and I basically made it into debit spreads. That way, I secure gains and I still write some more downside. So it's hard that you don't do that on cash accounts, right? You do the whole rolling or staying in the trade. So welcome. Today we're gonna talk about retracements, the action of today on SPY, possibly QQQ. I don't know if you guys noticed, but I haven't even posted any swings, and that's my bread and butter, right? But mainly because the market with the VIX where it's at right now, it's on a bearish sentiment, and even though there's stuff that moves up, like Apple has been moving up on the past few days, Pfizer, ABBB, or whatnot. Most of the edge it's on short time trades. So day trades, in and outs, take your profits and be happy with it, right? So I don't know if you guys noticed, but sometimes we've been landing the entries on the trades very good. You know, the entries have been like right on point, and it's no magic. It's just it's no guessing. You know, it's basically taking a chance where there's a very likely outcome for this thing to reverse and whatnot. So I don't know if you guys use Thinkorswim. You guys know how to use your drawing tools, and we'll start with my type of retracements, right? Well, actually, let me pull this up right away. So that's not the one. So we're gonna talk about defining a good entry. It's only 3 slides, right? So I just wanna use this for those main takeaways of using the tool, right? So the whole, I don't know, you see in the picture, I don't have all the feeble levels that usually shows. To me, it's basically a roller. It's not an indicator. It's like a roller, you know. It's for me to identify the levels at a certain areas on a trend or the move, and it's easy for me to grasp from just drawing with the tool of Fibonacci. So I'll show you guys what the best risk reward places to take a trade at, and then how to identify the state of the trend. You're gonna define your risk when you're entering a retracement with the feeble level, so with any retracement, and be be aware that you can use this across all time frames, dailies, hourlies, 15 minutes, 5 minutes, and avoid anything below 5 minutes, right? And in fact, move along as the day progresses to more for a higher time frame. You're gonna combine this with different strategies for profit taking and risk management, meaning that you can still do the bracket orders, you know, of the take profit at 30%, even though the move may call for more, but your risk management tells you to take most of the profit at 30%. You do so, or maybe you're shooting for a level. You also, risk management is not only profit taking, right? It's cutting losses, whatnot. So this goes against you. You know, you already define your risk. So you use risk management to know when it's enough to cut this thing. And for the S&P, it's using the tick chart that I explained before with the market internals. It's pretty good with the retracements. So next slide. It's nothing, but we'll see at the end. Cube retracements or Alfonso retracements. Which one to use? Which one is better? And we'll see that answer at the end. Hopefully Alfonso is listening. So, okay. So right here, we have the I don't know if you guys know my system, right? I keep the stock that I'm trading on the daily right here and the time frame that I'm using on right here. Usually if I'm doing SPY, I'm looking at it right here, but I mean I've been doing SPY, it never moves right here, and then the one that I'm moving, it's right here. And I'm sorry if I'm moving my mouse a little too fast, right? So we're gonna try to work this day out as if we just enter, even though we know now that this thing just came straight down. I mean, it just came straight down. There was no even need for magic arrows this time. It just came straight down. And I kind of said it in the morning, right? There have been situations where a whole run up of an FOMC reaction gets deleted the next 1 to 2 days. So here it is, you know, prophecy. The prophecy happened. And actually, I mean, I've seen a lot of videos trying to justify the move, what happened right here, and then what happened today. It's I incline more with the whole deal that there's what the spot gamma shows, you know, the band of flows and the whole world of options pushing this thing forward and then dying it down. So we have those options. Once everybody's loaded on puts at this point, you burn everything, all of the puts with this rally. Once everybody's jumped, it's after this rally on calls, you burn all the calls down. So I incline more with that aspect, right? But for what we're gonna see right now, I mean, it doesn't matter. We're just gonna see what the start of the day looks like, and we'll go from there. I'm not gonna use what's it called, the on-demand feature or anything like that. I'm just gonna go through the day, you know, that guys know that I use 5-minute charts sometimes at the beginning, and then I move forward towards that. So at the beginning, most of the times I don't start a trend with pre-market action. I do it with what the first candles print on the SPY. So I avoid any of the pre-market, any of the futures action. I do have it in mind for levels, you know, like here is knowing this is resistance, support, resistance right here. So you can know beforehand, this is all resistance supports because of the pre-market action, right? But one thing to notice today is that the pre-market action today was actually slightly higher than normal volume on pre-market, and on futures we had good volume at the start of the session. That's not somewhat a little abnormal to, because I even noticed my computer was slow. We were having volume on futures and futures options at this point. So right here, I'll delete these levels real quick. We identify those, right? It's just basic peaks, little supports and the peaks, you know, that we have on the overnight session. So one thing to notice is that today I should have taken into account pre-market since we had a bigger, higher volume. That should have been taken into account. And especially since we broke a new all-time highs on pre-market. This is way higher than the previous 473.54. But I didn't. This time I didn't take an approach of pre-market action. So I started my day off knowing that we dropped at the beginning with some red candles and then a retracement and then some other red candles. I think we fished this. Oh, look, come on, I'm freezing. Great, Thinkorswim. What's going on? Okay, I'm gonna remove the futures chart for now because it's I don't know what happens. I just get lacked out on futures when I'm got futures on. So okay. So the day started off with this red candles, right? And this is where I'm being patient. I don't take the first move because you'll get a retracement, right? Alfonso already had a set level for the bottom. He took calls around this level, and this was based, I believe, on, I don't remember what it was based on. Somewhere on the futures that we had like an overnight, probably the lows. Let me see. Most likely that's what happened.
It was the range for today.
Okay. So you took a call, you took calls right here, right? And it worked perfectly. It was a good, very good entry. I like, yeah, it was a range for today. Took calls right here and then got out at the right time. So looking to SPY right now, looking at SPY right here. When I first did the moves right here, I started off with any day with a starting point to the bottom of it, and did my whole retracements, right? So to give you the basics of this, all right, it means that when I do these lines, where I take the bottom of the range to the top, to the whole move, you know, from where it starts. Right now I moved it a little higher, but just imagine this right here. From where it starts to where it ends, and you already have a retracement going on. So if you think, if you incline the odds that this is an ongoing trend, that this came back down, push back up to come back down again, where are my possible best areas to enter a trade on this? So this is where I'll show you right here on an empty blank space right here. And I don't know, you guys want me to do it on a bigger chart so it'll look better? No, I don't want this. Let me see. Hold on. Just give me one second.
Just take the same chart that you were doing and expand it. Go to the previous chart where you had it, the small one.
And
right.
Expand.
Expand. Yeah, you got it.
All right. All right. So we'll do it just in blank right here. When I draw this, I don't know if you have started using Thinkorswim, your default drawing tool for a Fibonacci may look a little different. May look like let's see, reset to factory defaults. So reset, okay, and if you draw it, it'll look just like this is a normal one. It'll look red. I don't like the color red, combines with the red candles, too many levels. So what I do is just edit it, right? Delete the levels that I don't need. In fact, this one's I don't even need. And just select the color, something very more distinguishable, a lot easier to see, right? So So this is how I have it. Save as default. This is how I have my tool. So you guys can do that. You can customize it. So this is I only need these 3 lines right here. The reason is because when you have a move like this to the downside, or when you have a move to the upside, either or, let's take it, for example, to the downside. You have a move that starts from here and that goes all the way right here. When it starts going back up, you have 3 possible areas where this is gonna come back down and make the U-turn. So it works like this. The 38.2 level is gonna be the strongest for the trend to come back down. The 50 is gonna be the normal level, the usual retracement of stuff, and the 618 is gonna be the best risk reward for the trades. So the way it works is that whenever you make not everything's gonna be coming straight down on a. I mean, we're playing puts and we wish this thing will just crash and come back down, right? But it's gonna do it in steps and zigzags. 1 step, 2 steps down, 1 step up, 2 steps down, 1 step up. And it's not exactly 1 step back, you know, we'll take it, that's why we have these levels. So the 38.2 is gonna be our best, our strongest. This one's the normal retracement, and this will be the best risk reward. So I'll start with the best risk reward. So when the trend has been placed and you have the retracement, if you place a trade right here and it starts going up, you're still in a downtrend. You still gotta hold it because it may retrace right here because it's still a normal retracement. And if it goes back over here, you still gotta hold it. It's because there's still a chance for a downtrend. Once you start trading above this level, you're no more in a downtrend. You're trading on an uptrend at that point. So you have basically U-turn. So if you place a trade right here and it doesn't work, your risk it's less because you're already trading above it. You have to cut. Boom, you're out. That's it. If you do it right here, you just have to stomach this more risk. And if it starts trading higher, you have to cut this much red, you know, from between here and here. And obviously, this is more risk. So the best reward will come here because you'll have a better entry and it'll start coming down. Right. But you can also miss the trade because if the move to the downside is strong, it is really not going to get to this level. It's not even going to get to a 50. It's going to retrace right here at the 38.2. Because that's as much as the market allow on it's basically it's not like a magic thing or everybody's watching anything. It's just that the sellers come in full force in this downtrend and then they stop. They just relax for a moment. They let some buyers step in and take this thing a little forward. Let the bulls have a little chance, think they're gonna have it. And then they start taking the trend down again. And if you do it right here, this thing calls for another leg down, like way leg down, you know? If you do it right here, you call for a less level leg down, but it's still a retracement. And if you do it right here, you're just having you might actually do even a good leg down because you have the buyers that took it from here trap and they want to get out when it starts coming down again. So this is what the areas are. So that's the first takeaway from that we had. The best risk reward place to take a trade will be right here, but the strongest trends are sometimes right here. And we'll see on the chart how it went right here. Let me erase right here. So this is what I did. My thing didn't work. I took it from the start right here to the bottom right here. We did trade above this area, right? But if you have placed a trade and you allow yourself for a little bit of redness, right? You take the trade right here, a little bit of redness, and it starts coming back down. You don't really see the necessity to cut the trade. You're already in a very good place taking the trade around this area than having taken it here or than having taken it here. So you have successfully joined a good entry at this point, even though it went a little red. So in fact, this is actually a bad example, because to me, when you're trading above it, it'll be one of the rules to actually do. So okay, we erase the move, but I think I'm not gonna use that much 1 minute candles, right? But if you look at the move, when that candle formed, it was like right away. I don't know, guys, you notice it was like, this is a 1 minute chart. The rejection was right away, even though it traded above that. The rejection was right away. Oh no, I'm sorry, right here. It was right here. It wasn't right away, but does this show up on the 5 minute candle? Oh, it did show up. So yeah, I mean, immediate reaction, you have to ignore that, right? So let's go for the next sample. So you have, I'm sorry if I don't want to make everybody dizzy, right? But let's say that you have placed the downtrend right here, right? This is where my mistake was, right? Because I took my trend line, I took my retracement, I went like this. I took the trade somewhere around this area. This thing went super red. I had to hold it because it might retrace right here, and it went higher. And this is where I think the downtrend has been broken, and we have changed directions, or at least on a consolidation period. And that's why I let it go back down, but then I saw this again, and that's when I got out. That was my mistake. So when I look back at the chart, this is when you start using don't let your quick decision to stop paying sometimes to take a rash decision, right? Because you gotta find reasons to sell or reasons to stay, you know. So I was overwhelmed by the reasons to stay. So when I went back to the 15-minute chart, if I take the last consolidation period right here, and then it starts initiating a drop from the 15-minute chart, and this is taking into account what happened on pre-market, right? Because we had enough volume to consider this time. And moves, you know, it was not consolidation from the start. Sometimes you open with this consolidation and it starts coming down. Then, so I should have taken my level from here, my 15-minute, to my bottom of the range, because you have your retracement. Where do you get the trade best entry? At the 618, right here. So this is where I failed, guys. This is where I failed to look at this time frame, to my 15 minutes, from the last consolidation period, from the start of the run to the bottom of the run, right there. We have a retracement. We hit the 618. You get an entry right here, and then you start coming down, right? So my mistake on that part, but you guys see right here that it was. It's still a good tool to use. It is not, I didn't use it correctly. So, but it's still a good tool to use. So when this happens and we have a new consolidation, a new high right here, and we start making a new leg down, right? I have let's see, my 5 minutes. This is where more entries come in play, right? All right, we reject right here. We have this consolidation area. So basically we do a drop right here. So where do you take this? Where do you take this drop? Where did it start? So we take it from the top of the drop to the bottom of the drop right here. So we go back to the lines again, right? So this, where do I join? If this starts turning green, and I think this is still a downtrend, where do I join this trade? Either the strongest one, the 50 normal, or wait for the 618. If you wait for the 618 on this one, you don't get in this trade. You missed it. You get at the 50% level, you get on the trade, and you start coming down. This thing try to place a double bottom at this pace, but using the same tool, using the same guy after consolidation, and the same idea. From this high to this low to this drop, your next area to enter, even though this is a smaller range, is still applicable. It goes back to the same 3 lines, right? You take the retracement, this one for the best risk reward, or the 50 or the 38 too, right? But as long as you stay underneath this, they still do for a leg down, you know. I'm sorry. Oops, sorry. Freaking mouse. Right? So this is another example. So we have the consolidation period right here. Let me erase this real quick. We do the leg down, and then a little, right now the 5-minute candles are looking a little blurred, a little mixed up, right? Because you want to look at, you want to take a green candle as your retracements, right? But as your first start of the retracements, but you need a a sequence of green candles to know your retracement. So let's take, for example, the consolidation area right here. You take the high right here to the low of the drop to where you start having green candles. And in fact, the low, it will be this one right here. And I moved the top a little bit. Okay. So you take the high where the drop starts to the drop ends to the retracement, and you got your levels to join the trade for more puts right here. Where to re-enter puts? That's when people are asking, where to re-enter puts? Well, you hit the 50% and then you have to take a chance. You take your chances, right? So we'll move forward. We'll move forward from here. We'll move forward from here, and then we'll take it that this, retrace it. It made a leg down from here, this high, to this low right here. And we did get a little, if you wanted to join a trade and you took it at the 618, even though it traded a little higher, no candle closures, you still get a good level, good entrance right here, but this is when it starts getting choppy. This broke this downtrend. It didn't come back down that much. And actually, if you want to take it, like if you want to see if this was a comparison to the downside, you can do it to the upside as well, right? From the lows to the highs, right here, from the lows to the highs, same idea, lows to the highs, you have your retracement, boom, you have your levels to join the trade, and then it goes up right here, right? But this is, to me right here, there was a lot of, actually, I think I took puts at this level. I took some SPY puts at this level, and I think I closed them around right here. I'm not sure, I'll check it out. But anyway, this was more a little bit of the downtrend was not as strong as this continuation right here, like this. It kind of like wanted to move up a little, just like what it did right here, right? Instead of coming straight down, it wanted to hold the line on the sand. So times like this, I mean, 5-minute charts is a lot of information to take in at this time. So 10 minutes or 15 minutes. I use 15 minutes. So the picture will be a lot clearer, right? So we'll take our levels from the start to the drop to the bottom, and we have our entry right here. We have our entry right here, the 50 and the 38.2. We have our entries right here, even though like it looked like on the 5-minute super, like it wanted to change trends right here. On the 15-minute, doesn't, you know? You can still take this trade around this area, and you're gonna be good, you know? You're gonna be more patient and everything. So the drop happens, you use your risk management, other levels to take profits and whatnot. This is, oh, by the way, I mean, you guys seen that I've been nailing entries, but I don't nail exits. So I have to work on that. Sometimes, you know, sometimes nail entries. So we'll take the top of this drop. We'll take it to the bottom of this drop. We'll look at the levels. And right here was invalidated because we were trading. We had no candle closure, but you could have taken a trade right here, still be profitable at this point. But there was it traded way above it. So it would have been uncomfortable to hold this trade like this. But you guys see the power of this, right? Or the usefulness of this, right? Okay, let me see what determines it's been consolidating. Well, what determines is the amount spent of the same area. So if you look at, I'm gonna go back to the 5-minute chart. If you look at this action right here, there was no direction at this moment. You know, you traded around this price, you come back down, you come back up, you come back down. You're already on consolidation period right here. you know, this is a consolidation period, and then you take your drop, you know. You spend a considerable amount of time on the same area. It's a consolidation period. And this is like I said, there's no magic tools. This is nothing like the I don't know how to explain it, but this is just market psychology, right? That you have buyers, you have sellers going in hard. They relax the foot on the pedal, right? They let buyers come in, take some orders up, and then they slam the sell orders again. They do the same, slam the sell orders, and so on. And at the end, you can have something like this, which is not what's been happening all day, and I'll call it short covering. I mean, whoever's not comfortable holding shorts, they're gonna drive the price up. And this is I'm gonna is there a question right now? Because I'm gonna jump to the next point. Anybody? The stats, you got it? Okami, Jet. And actually, let me tell you something. You guys know when we have bull flags and bear flags and whatnot, right? When we talk about those on when we're trading, right? So, for example, you have this. Let's use a good example right here. One that's very clear, right? This one came back down. You have your flag from here, you have your move, right? From here to here, you retrace, and then you do the next leg down. So this is a classic bear flag right here, and you guys can see it, right? Right here, right here. I don't know if I do it. It's not pretty. It's not pretty, but you guys get the idea. Oh, it's right here. You guys get the idea. You guys know what a bear flag is. So it's basically moving up after a downtrend and then do the next leg down. So people join the bear flags when this breaks down, right? When you break this little uptrend right here, they join, you start trading below, they join the bear flag. I don't like to do that. I like to be the guy that buys the puts, not at this break. I like to be a guy that buys the puts at the best available price for me for a better risk reward ratio. So the strength of the bull flag is determined by where the highest of the retracement went to. You know what I mean? Like if it only this I think we talked about it intraday. If the only retracement it made it was to the 38.2, or this thing is gonna flush down. You know what I mean? It's as strong as the buyers could take it to this level, so it's gonna bring it back down. So I think Alfonso was in a trade somewhere around this area that I think it was this one that we traded right here to right here, right? And we only, I believe that was having my line from here to here. Yeah, that it was already, this one was in, I think, yeah, it was this one. He was in puts right here, and I was telling him, you know, this thing is not even making it to the 38.2, so the next leg down is going to be pretty big. It did made it a little higher, actually giving a better entry at this point, but you can see the weakness of this retracement to the upside right here. There's no way you're gonna reverse from this, so it makes a nice leg down. This is a pretty nice leg down right here. There's many points. And it goes as well as bull flags, right? So you started trending to the upside, and I would say actually right here it was kind of like a fake bull flag. Like you take it from the bottom to the top right here. You retrace to the downside up to this candles, but you fail to make a. This is where I got out. Actually, this is why I got out, because you made this move upward all the way over here. You retrace right here and you start making another leg up. It's like a bull flag already breaking to the upside. It's just, that's what it looks like, right? But what happened right here is that it failed to make a higher high. So basically from this high to this high, it's a lower high. So it's a high, lower high, lower high. So you're still in a downtrend right there. And I was already pulling out of the trade right there. And then I look on my phone and I see this red candle. I'm like, God damn it. So, okay. The next topic is we already, so going back to this, we identify the best risk reward, where it did, the state of the trend. That's where we know if it's strong or not, or if it's retracing at certain levels. The risk before entering the trade, so you know if it's trading above the 618, you're wrong. You can you say across all time frames, and especially you have to move through time frames, you know, so you have your reasons to stay and to sell. You're gonna combine this tool with different strategies for profit taking and risk management, and now the tick chart. All right, that's a very good one. So last point is that my beloved tick chart right here, and I know it's looking small, but you guys heard me talk about market internals before, and I place a significance when I'm trading the SPY on the ticks when those retracements are happening. So I'm gonna pin it right here. So when I'm probably not gonna be able to pinpoint because it had to be live, right? But let's say that you're at this point on SPY and you already made this bottom, double bottom, triple bottom, and you start breaking it right here. You broke it right here. Right here is the tick. I don't know if you guys can follow the little white line right here on this break. You guys see this tick, very strong tick, a negative 1,000 tick on this break. That's his confidence for what that you have broken down. You know what I mean? Because I already looked at my retracement, right? I already joined a trade at the 618, and I'm already at the lows of the support that we had earlier right here. And we broke it with a negative 1,000 tick, confidence. So I stayed in the puts, and we keep going forward. So same goes for the upside. Remember, plus 600 or more than negative 600s are strong ticks to the upside and to the downside. So it's a pretty cool tool, right? I use it a lot for the SPY, even though remember the tick, it's only for the NYC stocks, so the NYC. So all the stocks are on the New York Exchange. So really, not all the stocks that are on the SPY are on the New York Exchange.
Another important point there in that specific example, Cube, is that when you match a lower tick with the lowest low of the day, most 95% of the time you're gonna have continuation on the down or up, whatever you are. So in this case, it was the lowest tick of the session in the lowest price on the session as well. So that means continuation to the downside.
Yes, exactly. We match a new low after breaking those lows right here, and a new low on the tick. Even though later on the tick made a lower right here, it doesn't matter. I mean, from this point backwards, it was the lowest of the ticks right here. So that's you have continuation at those points, right? So keep an eye on that. It's I love the ticks. I love the ticks. It's like the heartbeat of the market. I hope you guys are using it. Are you using it, Okami? You got Thinkorswim? Bilawa. I hope you guys are using it. Yes, I hope you guys are using it, and possibly not using it, at least watching it, right? Get familiar with it, with the little rules and everything. Remember at the start of the session, the ticks are a lot of noise. On the end of the session, there are a lot of noise, so they're less, they're harder to use.
And see, they don't use it because they have you, so they don't need it.
You have me on voice, yeah. And in fact, I mean, I actually, if I look at the last action right here, that we have this push up with this immense positive 1300 ticks, to me screams short covering, you know? It was driven by short covering right here. But I don't know, it's subjected to to anybody to present it as they want. So now, now that the part that everybody's been waiting for. So Alfonso uses retracements, but they're not the same ones. So are you Cube retracements versus Alfonso retracements? And the answer is they are the same thing, just in a different, used on a different form, you know. So what I'm gonna pull up the Alfonso, I think, setup right here. I don't have it anymore. What happened? No. Oh, can you share it? I used to have it.
You have it because it's a flexible grid, not a.
But no, I used to just open it right there.
You should have it there in the flexible grid. Go to your right. There's you don't have it there.
No, no, I used to pull it right here and it'll pop out, then another shadow traded is market internals done. No, which one is this one? No, that was for the tick one. No, can you share the link if you don't mind? So, or if you want to share your screen, and then we'll just go about the retracement to the EMAs, which is the same idea. You'll see that actually that the hitting the 4 EMA ends up being like the 50% retracement of the run or so, because our market, remember, it's not gonna be oh, are you I see that, Alfonso. I see the message. You're trying to hit me where it hurts. The one that I saw for a loss.
No. I paste the script, but for some reason it didn't copy it and just paste the last message that I posted.
It's right here. It's right here.
Yeah, but I already posted the script for you.
Okay, let me just
you cannot erase messages from here, but it was.
I already found it. It was on the share setups right here because it's a whole setup. Yeah, you're right. So
yes, and it's just on the workplace more than
yeah. It's actually right here. So right here we have I believe right here is just where we have it, because I haven't used your setup in a while. I just watch it from the stream, right? So right here we have the 4 EMA, the 8 EMA, and the 13 EMA. So right. All right. So right here, Alfonso uses this a lot, right? So what happens when it starts having retracements, what you have is a run and an overextension, right? The price is trading around this level and the EMAs are all the way over here. So what the price essentially does is retrace. Let's say that my 618 levels are around this area. It's also the 13 EMA, you know, or the 50% is going to be around the 80 EMA, or the other one's going to be the it's not exactly right, 4 EMA, but it's the same idea. If you think about it, 4 candles have to have an average price, and that'll be the line represented right here, and they're exponential, so they're calculated differently. 8 candles right here.
You can put the Fibonacci there, so you can see the levels towards the retracement.
Yeah, so we have it from this right here.
From the top, yeah. No, but from the top of the first candle.
Yeah. So from the breakout consolidation right here, right?
Yeah.
This is from the first right here. So yeah, we have actually, I mean, this thing retraces this does the whole rundown, retraces to the 618 or so level right here, which is represents the same EMAs. So that's why Alfonso will stay in a trade like this still, because there's no confirmation to change trends because you're not trading above it. Even though, so this candle, it may have looked at some point like a greenish candle like right here. That looks like it's gonna trade above the EMAs, but then you see the wick and doesn't close right there. So the EMAs is still intact and the downtrend is still intact.
So if you see my, as Cube said, my 4 EMA is the 38, the 8
Yeah.
is the 50, and the 13 is the 60, 61,
Yeah.
68.
Yeah,
So it's the same.
it's the same concept, same idea.
On the 10, that's what I use the 10 minutes,
Yes.
because on the 5 minutes is different.
Yeah, you'll have to use different EMAs on the 5 minutes, right? Because they just, it's just gonna be so many candles that the EMAs are gonna be dancing at the middle. You have to have bigger,
The,
not bigger.
the average is different. Yeah.
So you guys get the whole idea? Do we need to go over another point or something? Okay, so do you guys prefer exponential MA over simple MA? Well, on these cases, yes. I do use simple moving averages, but they'll be for like a daily 20, a daily 50.
Yeah, simple moving averages are most used in larger time frames. The exponential is a little bit more exact, and it's the simple are slower, so they are smoother, and the exponentials are a little bit more, we might say it aggressive, but or more dynamic is the word. So they adjust quicker than the simple moving average.
Yeah. Yeah, and then if you see like an Alfonso setups right here, if you notice, this already broke the downtrend right here, even though it came back down later, but using the trading system of the EMAs, we close this candle above the 13 EMAs, so the downtrend is...
Actually, the exit there is the warning sign is the candle closing above the 13, and the
This one,
exit
right?
sign was the cross of the 4 and 8. 4 and 8 crosses
Right here.
and you get out. Yeah.
You're wrong, not playing the downside at that point, even though it came back down later, but using the trading system that Alfonso uses on the EMAs is right here. This is where you don't trade the downtrend anymore, or you're out of the trade, or you take your loss or whatever, right? Unless you got diamond hands and you want to hold it a little longer. What else? Yeah, for like, I'm gonna go back to... see right here. All right. So just also to answer a little bit of the questions right here for the moving averages and whatnot. The what I do sometimes, like I look at the daily and I look back to the history of the stock, right? Does it have more respect for a 20, let's say, a simple moving average or an exponential moving average? You know, if there's more times that it works on one in one moving average, I'll use that one. You know, like historically, that stock is trading with that moving average in mind, if that makes sense, right? And even for short-term trades, I'll take it into account, right? Yeah, I'll take it into account that if it was meaningful before, it might still be meaningful now. So that's what I do. Any other questions? Do you guys like it?
And actually, there is a script on a script to trade that they are selling now, that what it does is that the script looks which EMA the price is following, because each price is following certain EMA, right?
It'll tell you right there.
And it tells you which one is, and then you use that one as a support and resistance, right?
Nice, nice. Yeah, that's good. That's a good script because usually, I mean, as traders, we're doing it with our eyes. If you're able to identify that this thing is just rejecting the same one, and the same one you use, you know where you can get short, or you know where, or the downtrend, once that breaks, you know where the trend has changed and everything. But I like this day, you know, even though, I mean, I took an L on this account. I like that this day was pretty straightforward with trend trading, right? It was good enough. I mean, I'm sorry for bringing negative vibes to the day.
No, it's okay. But yeah, but it was a perfect downtrend day. It never broke the 13 EMA until the last 10 minutes.
Yeah.
So it right all the way to the 30 minutes. That's what I never got
Out. Yeah.
out, because it was, even though it was doing aggressive retrend, and sometimes it was trending on the 13. He was right in the 13. Sometimes I have said a lot that that I follow a lot the 4 EMA, but that is when you have a very strong momentum
Yeah.
moves, right?
So there was
And
a slow grind to the
sometimes the movements are not as strong, are like this one, that it was slow but consistent, and it ride it all day. So you just have to have the ability to identify what it give you. That is that when you have low volatility like we had today, usually you have slower movements when then you have a volatility of about 20, 30s, right?
Yeah. Yeah. So I think one of the main takeaways was the VVIX probably wasn't really moving up that much, making the VIX not move up that much. So meaning that the volatility inside volatility wasn't that big today. So it was a slow grind to the bottom, but it, I mean, it paid out. It was good.
How much it closed, by the way? The VVIX, it closes at 138.
It closed at 128.
128.
Yeah. So I think we had seen like on a massive bear days, you know, we had seen before.
Above 110 is considered.
It's high, but we have like a normal
high.
high now, right? It's everybody's trying to see what the normal
because
is on the.
I mean, since the COVID pandemic and everything, now we're used to see it over 110. But if you see before the pandemic, it was, you can count with your one hand and the number of times that the volatility on the daily chart went above 110. And that's what they call it, the Obama level, right? Or the volatility chart. You know who.
Yeah. And you can see like on the daily chart, the VVIX, you see these three big spikes are this day, and this day right here on spike. So even though this had a small range, it was probably a very volatile day where it moved a lot. This was a very bad, bearish, volatile day to the downside. And this was also a very bearish day right here. So the VVIX really didn't spike that much this time, right? So it was a slow grind to the downside. It's pretty cool. Pretty cool. What else do we have to cover? So that's it. I mean, that's all I got. We actually did the whole hour. I can't believe I went to the thing in 1 hour. I thought I was gonna do like 20 minutes. And that's it. You guys ready to use it? You guys ready to try it out? Or understand the entries better?
What I can probably you can also explain, just for the last comment, is how do you use, this is the retracement, but you use also the extensions when you don't have levels in order to see next levels. So
So yeah, so sometimes like let's say that yes, the instead of having taken puts, right, waiting to take puts, we start seeing that this reverses and we want to take we take calls, and where do we get out? We use the same tools, right? Like we take from the initial drop from consolidation into the drop right here, right? We have taken calls at this point because we think it's overextended. We look at the EMAs on Alfonso's screen and we see, oh, this thing is overextended. Let me take calls because it's gonna come back up to overextension. How far do I take those calls out? Either right here, or right here, you know? So it's is that what the answer with the question is? Or?
No, I was, for example, let's pretend that below the, just put the retracement how you had it there. So we're gonna do exactly what you had before. Okay, let's assume that below the 0 level, we don't have, that is the lowest all-time lows, and we don't have levels to the downside.
Yeah.
So how do you find the next targets? What you do is you take the previous consolidation, which you're gonna make an extension now, Q, from the 50 to the 0. And exactly. And those are your next levels to the downside.
Do you, because I don't really use this tool that much, but this will be great because if you notice, I don't really know
So
where to take profits.
Imagine that you don't have levels on the, I mean, we do have historic levels here, but we are just making an example. For example, imagine that below the 0 line, we don't have any reference. So what you do, you take the previous range, which in this case, the previous range was from the one that you took from the 50 to the 0. And can you see that's the previous range that we had? Yeah. And then you make the extension to the downside, and you can see the levels there that they
like 100% level right here. And
they match perfectly, right? And so now you have levels. When you tell me, okay, what are the next levels? Okay, I do more or less like this, and I say, okay, I have we're going to 469.30. Then if it breaks for what it says, 469, and you have to.
Yeah.
I mean, you can get rid of the ones that you don't use, but
probably
that is a way. That is an extension. It's not a retracement.
Yeah,
and that is the difference between extension and retracement. And how do you use your extensions in order to identify future levels when you don't have a?
Yeah, that's good. So I can use that for profit taking. I just have to decide which one of these levels I'm not gonna get rid of because it's too many, right?
And you just have to, I mean, what experience gives you is more or less, okay, why these matches vary to the levels, because I already have experience identifying the previous range, right? Because that range that I told you was the one who determined the levels below, right?
All right, I could use this. Yeah, a 50%.
You can see how beautiful. I mean, they match.
Yeah, I'll try to use that better so I can start taking profits better on those things. And one of the things that I actually forgot that I've seen, when you have a move, right? Because this is a 15-minute move, right? When you have a move right here, right? And you break and you have your retracement, usually you can extrapolate the move from, let's say, from here to here, right? The lows right here, you just draw your line. And right here, let's put it a little more exact, just for fun. And we take this, extrapolate the move from the retracement. And usually some people they take it to the either 50% or so. But that's how they take it, you know, like you do your 2 steps down, 1 step
No,
up,
no,
2
and
steps down,
you do the retracement cube.
which is the same idea.
Take the retracement and do it again from the 100 to the 0. The extension. 100 to 0. So what I have there, usually I and then edit it and add a 10%.
So take all of off and then
no, get rid of the instead of the 23.6, put a 10.10. Okay, and then you go to the 38 and 50 and 68. It's all I need.
okay.
So usually when you have a retracement, guys, most of the times you hit the 10%. So actually I do my first stop there. That's my first. The second one is at the 38. And the third one is at 61.8. Those are, and if you see, those are the famous 30, 60, 90%. So it always, you take the retracement, the complete retracement, you always hit the 10%. That's the first target. The second target, the 38.2. And then the third one is between the 50 and the 61.8, which is the 90 and 100%, right? And then from there, you leave the runner. And the runner goes whatever they are.
Yeah.
Usually the good runners go to the 100 extension again, or even further. So that's the way to do it, guys. So that is the magic about.
Nice.
And that's how you find targets when you have to get out. I mean, so usually when you have an inside candle or an inside day, what you do is this one. You take or usually the trade on the break.
Yeah.
You
and then
put the range and then you go.
Yeah. Yeah. And then we have used the extensions and everything on inside candles and then all-time highs or stuff like that.
So that is the magic. Okay, exactly. That's the revelation of the magic.
Yeah.
Now you know how to make the trick. Yeah, you have to make the trick, and as a good magician, you have to practice a lot so the audience cannot notice that you're doing magic, right?
That they think, oh, like, how did you nail the entry or how did you nail the exit? Well, because you're just using your tools, you know.
Yeah. And you have to trust them. Not all the time are gonna work exactly, but if you do them 100 times, you just need 40% of the times to work for you to be profitable.
And with good risk management.
What is following is using management, exiting either when on your stop loss or leaving only a starter. But if you somehow respect your maximum loss on every trade, after 100 trades, you're gonna be profitable. So that's the reason that I don't get obsessed with one bad trade because it's only one trade out of the 100 that I have to do in order to achieve my goal. It's not in one trade that I'm gonna get my goal, right? It's a repetition of several hundred or tens of trades that with probability and good management, it's gonna give you the results that I'm looking for. The problem is that you want to make up everything in one trade because of the previous one that you messed up, and that's what the disaster arrives, right?
Yeah.
You had to take it step by step.
Alfonso doesn't get mad on losing trade. He gets mad on when he wins 100K instead of 1 million. That's when he gets mad.
Well, that's a different story, but I do get mad. I mean, I don't but I don't let my feelings get over my logic, right? I used to be very very emotional, and that messed you up for the future trades. And then you have that feeling that you want to quit, that you don't want to continue, that you are fearful for the next trade. And the next trade doesn't give a damn how you're feeling. I mean, this is only you in your head. So that's what you never have to. If you follow your same rules and you already understand your retracements and your targets and everything, you just have to do repetition, repetition, repetition. And you have to assume that half of them are going to be wrong, half of them are going to be right. And that's part of the, if that happens, you're doing the things correctly. That's what, that is what you're expecting.
Yeah. So I think after today, I'm gonna be very diligent on the getting the entries, that we won, and the take profits, to start practicing take profits, because I'll be honest with you guys, when I'm very focused to enter a trade, like laser focus eyes, and then once I'm in, I'm like, do I sell? Do I cut? Is this working? So I completely forget the profit taking strategies. That's why I should start using probably bracket orders. So.
Yeah. You put the bracket orders and then you don't even notice when they start taking profit for you, right? It's already there.
Yeah. So there was a strategy, like I said, I try to get a short right here.
Again, I use market. I only use brackets when I have a lot of trades at the same times that I cannot manage them all at the same time, right? But when I'm doing trades like lately that we're having only 2, 3, I personally don't use it because I like to manage it manually, and I'm able to do it, right? I have the ability and all the tools here to manage the trades manually. But and you shouldn't be in more than 2 or 3 trades to begin with at the same time. And if you're doing that, you are breaking already the more of the basic rules that focus on less trades, even go heavier on the trade. Instead of having 10 trades of $200 each, have 2 of 500.
Yeah.
And you're having the same risk in terms of dollars, and you're having more odds to be successful because you're going to be able to manage. And because literally you have to be watching candle by candle in order to be the most effective of you can in order to manage your trades, right?
Yeah, exactly.
And that's what I use 10 minutes. Imagine managing candle by candle, 5 minutes, 1 minute. No, you get crazy. So 10 minutes, that's enough for you to manage it step by step and determine. I mean,
I don't stay, by the way, I don't stay in 5 minutes all day. I started the day in 5 minutes and then I moved.
no, I
like,
understand it. And
when I have like
sometimes
this much.
I do take in consideration 5 minutes. It's a great time frame for the first 20 minutes of trading. I mean,
Yeah.
that's the one, because if you wait 10, so imagine, right?
Yeah.
So 5 minutes for the first 20, 25 minutes, it's perfect. Because at least you need 2, 3 candles in order to determine a range. And at the end it is what it calls the opening range, guys. It's the first 20, 30, some people take 20, 15, 20, 30 minutes. So you take the opening range, and there's a strategy that people likes to, once that they put the opening range, the first 3 candles on a break up or down, they take the trade. If you can see here the example, we can assume, for example, the opening range is the first 3 candles, and you take the trade on the break on the range, which is the 5th candle, right? That
Right,
one
yeah.
you take there. And that is the other type of strategy that I use, that I don't wait for retracements when I'm playing breakouts, because there is no retracement on a breakout.
Yeah.
I play the break. Sometimes you see out because you never take the dips, or it's not that I'm not taking the dips. I'm playing a different strategy. I'm playing a breakout. Not all the time happens, but what I'm playing is a breakout means that you don't have retracement, you have continuation to the side that you're taking.
Yes. So, we already went over the hour, guys, but if you wanna have questions, open your mic or we just end the session right here, however you guys like. Open your mic and do a question, we'll answer it real quick, or we just say good night to each other.
Yeah, I think it was a very interesting session. Hope you like it, guys. And see you
Save one
tomorrow.
for the books. If you guys wanna go over it and whatever, it's gonna be uploaded. Stats